When you become a Walmart Plus member, every time you drive, you're saving money. Like driving to that yoga class you take every Monday. Okay, some Mondays. Or driving to brunch with friends.
On my way.
What? You haven't even showered yet. Or finally taking that road trip.
Paris, Texas, watch out!
With Walmart Plus, you save 10 cents a gallon at Exxon and Mobil stations. So every time you leave your house, you're saving. Fuel discount varies by location and station, subject to change.
This is Optimal Finance Daily, episode 2288, Key Value Stock Fundamentals for Screening Stocks by Robert Farrington of thecollegeinvestor.com. And I'm your host and personal finance enthusiast, Diana Merriam. Welcome back to another edition of Optimal Finance Daily, where I read from an article that can help you live a life that's a bit happier and more financially sound. So for now, let's get to today's post and start optimizing your life. Key Value Stock Fundamentals for Screening Stocks by Robert Farrington of thecollegeinvestor.com. The hardest part of deciding where to invest is actually deciding what criteria you want to look for in a company. I'm a huge value investor and look for solid companies that can be purchased at a discounted price, maybe due to bad short-term news. The trick to finding these companies is to use a stock screener. Most online brokerages have them, as does Yahoo Finance or Money.com. What I highlight next are some key fundamentals you may want to look at when investing in a company. Remember, a number or ratio may look good, but it's important to understand why that number looks good, or if it looks too good. These key value stock fundamentals will help you do just that. Number 1, market capitalization. While market capitalization may not matter too much for small investors, it can play a role in the types of companies that you'll see. I prefer to exclude micro-cap companies, which are companies that have a capitalization of less than 300 million. The reason for this is that most are young startups or highly volatile companies, and as a result, it can skew some of the other measures that I like to screen by. However, it's also important to note that micro-cap companies do make up the bulk of the stock market. Right now, there are 5,678 micro-cap companies that are publicly traded, while there are only 2,489 small-cap and larger companies traded. Number 2, PEG ratio. The PEG ratio is a valuation metric for determining if a company is fairly valued. It's the PE ratio divided by annual earnings per share growth. A ratio of 1 means that the company is fairly priced, while a ratio of less than 1 means that the company is undervalued. The reason I prefer this metric to the P/E ratio alone is that it provides a look at whether the P/E ratio is excessively high or if it actually reflects the company's growth prospects. The main disadvantage to this measurement is that it doesn't work at the extremes, very low growth or ultra high growth. It also relies on the estimate of the company's growth rate, which is not a definite number. This is why it's only one criteria in the overall screen. Number 3, profit margin TTM. The profit margin is a great indicator about how the company is performing. When looking at this metric, it's important that you look at the TTM, or trailing 12 months. This gives you finite data on how the company performed over the past year. When looking at companies, it's extremely important that you compare the company's profit margin to the industry in which it operates. You can't simply assign a margin amount that you want. Each industry has different standards for profit margin. In high tech, the margins can be very high, but in industrial production, they may be much lower due to input costs. While screening for this category, you want to look for a company that consistently has above industry average profit margins, and you want to know why. This is key to possibly discovering the company's competitive advantage in the market. Does the company have a technology that lowers costs? Are there contracts in place for years that allow it to buy its inputs at below current market rates? The answers to these questions will allow you to make a very informed decision about the company. Number 4, price to book ratio. The next great indicator to look for is price to book ratio. The book value of a company is the company's total tangible assets less its total liabilities. This ratio gives you an idea of how much an investor could have if the company went bankrupt immediately. A price-to-book ratio of less than 1 can signal that a company is undervalued or that the value of its assets minus liabilities is currently worth more than the share price. So if the company went bankrupt immediately, you could actually make money, although highly unlikely. The important thing to remember is that book value varies greatly for different industries. Also, a company in distress may have many more liabilities than assets, making this number meaningless. Finally, the book value does not include brands and intellectual property, which for some companies is their main asset. In such cases, the book value may also be meaningless. And number 5, dividend yield. I like a company with a positive dividend yield, even if it's very small. Dividends are great as they can show that the company is financially healthy enough to pay its shareholders. It's important to look at the payout ratio of dividend-paying stocks to ensure that the company is able to continue paying its dividend. Value investing is not about turning a quick profit, and it may take a long time for the value of the company to emerge. However, if you focus on companies with a dividend, you're essentially paid to wait. As with all investment decisions, it's important to do your homework, and I hope this guide helps you with that homework. You just listened to the post titled Key Value Stock Fundamentals for Screening Stocks by Robert Farrington of thecollegeinvestor.com.
Too late isn't in your vocabulary. Reach your next goal at University of Maryland Global Campus. Get the accredited education you want wherever you are, on your own schedule. UMGC offers online degrees and certificates to help you level up your skills. Apply now and save with no application fee through May 31st. For more than 75 years, UMGC has been transforming adult lives. Access online courses, faster onboarding, and success coaches that help you along the way. Plus, UMGC makes an accredited online education more affordable than ever with scholarships, interest-free payment plan, and no-cost digital resources in place of most textbooks. Choose from more than 125 degree and certificate programs in career-relevant fields and receive lifetime career services at no additional cost. Gain skills local employers are looking for in business, cyber, IT, healthcare, and more. Get started on your undergraduate or graduate degree or certificate online. No application fee if you apply by May 31st. Learn more at umgc.edu/podcast. Certified to operate by Chev.
If you've recently bought anything, you've noticed that prices have gone up on almost everything. But thanks to our new sponsor, GoodRx, you can save on something particularly important, your prescription medications. GoodRx is the fast and free way to save up to 80% on the price of your prescriptions. All you need to do is search for your medication on the GoodRx website or app and show your discount at the pharmacy counter. It's that easy. Not to mention, GoodRx is accepted at all major pharmacies. And even if you have health insurance, GoodRx may still beat your copay price. You know how much frugality means to me, how many ways I try to save. But never before have I seen a way to save on prescriptions. I really love GoodRx. It's extremely easy even for older friends or family that I've recommended it to. So for simple, smart savings on your prescriptions, check out GoodRx. Go to goodrx.com/OFD. That's goodrx.com/OFD. goodrx.com/OFD. So I talked to my friend Frank Vasquez from the Risk Parity Radio podcast about this article because I don't often find myself contemplating value stocks. Frank pointed out that the big picture backdrop here is that academics have long observed since the 90s that value stocks, and particularly small cap value stocks, tend to outperform the rest of the market over long periods of time. But this has been turned on its head since the great financial crisis in 2008, and large cap growth stocks like the FANGs have outperformed by large margins. Contemplating value stocks is really rooted in trying to beat the market by investing in particular sectors. However, we don't need to beat the market to be successful in investing. The fact of the matter is, as mere mortals, we cannot know what is going to perform better in the future. What really matters is our portfolio allocation mix of types of investments, like stocks, bonds, REITs, not what is in each bucket. The reason is because all reasonably well-diversified 100% equity portfolios are going to perform at least 90% the same. Likewise, all reasonably well-diversified 80-20 or 60-40 stock-to-bond portfolios are going to perform at least 90% the same. So as long as we get that piece right, we should just focus on owning low-cost diversified funds and not get hung up on growth versus value or small cap versus large cap. Again, we don't need to be able to predict the future to succeed, and our success is not defined by beating the market, but rather by meeting our individual financial goals. So I think that does it for today. Hope you're having a great day. Thank you for being here, and I'll see you on tomorrow's episode where your optimal life awaits.